Banking now, and what we should expect from banking and NBFC, the sector for this earnings season. Liquidity is high, yields are low, and credit growth is also down. So all of that is actually not adding up. Dayananda Vaidya, research analyst, BFSI vertical with Axis Securities, and Shweta Daptar, vice president and lead analyst, diversified financial with Elara. Good morning, everybody. Thank you for joining us. And Shweta, liquidity is back, interest rates are low, yields are down, and credit growth is down. Normally, with low interest rates and high liquidity, credit growth should be picking up. It's the other way around. Why is that?
Good morning. So you're absolutely right. Macros are pretty conducive, especially the low interest rate regime. The liquidity flush in the system definitely augurs well for NBFCs in particular. However, the scenario is definitely different this time around. NBFCs have navigated distinct set of challenges for the entire of FY25, largely emanating from regulatory forbearance and developments in the sector. So unsecured loans and microfinance loans continue to remain sensitive to the overall asset quality performance of the companies in the NBFC space. And due to this, the companies have turned slightly cautious and prudent to add on new customers or to acquire new businesses. And that is one of the key reasons why credit growth is still looking slightly soft and sedate. Also, we have to understand that Q1 tends to be seasonally soft quarter for NBFCs in terms of growth. But yes, having said that, the regulatory developments are necessitating changes in framework on the operational side and also certain regional challenges led by asset quality upheavals will definitely see NBFCs putting up modest to softer growth for the entire FY26.
How is it that you've read into the business updates so far for the first quarter from both banks as well as NBFCs? And are you also of the opinion, like Shweta, that we are maybe going to head in or see some amount of softness, at least for the NBFC sector?
Good morning. From the provisional updates that NBFCs have put in, Bajaj Finance was the ones under our coverage. Bajaj Finance posted a set of numbers. AUM growth was also healthy. Also, we believe that it's a beneficiary in this rate cut cycle and should see margins improve. Asset quality, from an asset quality standpoint, we don't really expect a lot of pressure or headwinds for the company. However, we remain cautious on the microfinance sector, wherein growth has also been moderating, mainly because of asset quality challenges. We see these challenges persisting from at least in the first half of the year, especially with two geographies where companies that we cover, which is Credit Access Grameen, have been facing challenges because of the ordinance. We expect a better second half for microfinanciers from margins as well as credit cost standpoint. For vehicle financiers, we expect that growth would be modest. However, amongst the NBFC pack, we believe that vehicle financiers would post better growth. Margins will benefit with this rate cut. However, we'll want to watch out for credit costs and asset quality movement for vehicle financiers. Yeah.
Are the pockets that are facing some bit of a pressure, case in point being vehicle financing. But Shweta, just wanted to get back to you on your expectations with respect to the sector, specifically from the first half of the earnings season. What sort of a NIM compression are you anticipating at this point in time? And along with that, what's your overall sense that which pocket can actually be one of those laggards with respect to the earnings?
Yes, so NI definitely will not decelerate, but apparently most of the earnings or the top line is looking mixed for this particular quarter. So at best, NI will be modest. And as you rightly pointed out, it is largely managing from certain sub asset classes, which definitely continues to reel under pressure. So obviously, microfinance, although the fresh delinquencies have been largely curbed, still the headline asset quality and the soft buckets continue to bother. Also, new customer acquisition is a very small portion of most of the NBFC MFIs loans, so that might not have a significant impact on the positive side on asset quality. On the unsecured lending side, that is personal loans and credit cards, again mixed signals. While there were pressures in the small ticket segment, now there are pressures. Our channel checks indicating on the urban side, on slightly on the larger ticket side. Vehicle finance, so look, first half tends to be any which way softer for vehicle financiers, and it's a fixed rate book for most of them, so no margins uptick as well. And more or less, if you see again in the driver come owner segment or the earn and pay segment, you will see definitely slightly pertinent asset quality, cash flow issues for these driver come owner segment. So net net, not a very positive scenario building up in the first half for vehicle financiers. So there will be slight laggards. But overall, I believe home loans, gold loans, loan against property has picked up really well for NBFCs slash HFCs. So I think these are the segments which will sort of remain or will have an edge, say in the first half and even for the full year.
What about smaller banks, Shweta? Can they stand out? They're cheap. They would have the
You meant
highest.
small finance
Small, no,
banks?
I'm talking about mid-tier banks, small finance banks, not the top 3-4
Yeah.
names.
Yeah. So look, we at Elara really believe that if there is a microfinance turnaround, which is happening, so I think small finance banks will also be better placed to sort of take bets on to bank upon this microfinance turnaround, because given the new regulations wherein 60% can be MFI concentration in the overall lending book of these NBFCs as well as SFBs. So I think most of them will look for diversified product profiles. So I think small finance banks on a longer horizon should do well because they already have a well-established diversified product franchise.
All right, so that's the take coming in on the small finance and the names out there. But then I'll also talk to us about the valuation picture as well, because from those March and April lows, we have already seen a good run up in most of these financial majors. What's your overall sense on the valuations right now, given the growth picture that we have been looking forward to, and maybe the pressure points that we have discussed right now? Do you believe that the valuations are justified, or is there any room for correction from these levels?
Yeah, from a banking standpoint, we believe that there is some further upside left, even in the bigger banks. We also remain positive on certain names in the mid-sized banks. We like City Union. We still believe that there is scope for a re-rating, given that after the tech uphaul, we see there is overall we see that there is a scope for credit growth improving. Also, asset quality right now, at least in the secured segment or even in the corporate segment, does not seem like a challenge. Small finance bank, of course, it has its own set of challenges that it is dealing with, but we expect some recovery in the second half of the year, and we do see some upside in. We see a better upside in the small finance banks, given that's contingent to the recovery that they post. Yeah.
What happens to the entire deposit chase, which is, currently playing out? I mean, BOB waived off its charges to customers for not maintaining minimum balance in their savings accounts. The Canara Bank, Indian, PNB, etc., have made some similar announcements. Who do you think is going to really win the race here?
So from a deposits perspective, banks continue to face challenges not only on deposits but also on from a CASA growth perspective. So it's of course we expect that deposit growth for banks will remain largely in line with the credit growth that they post. For BOB in particular, we expect that these challenges will persist. So we don't look at a deposit growth of more than about 11-12% for the bank.
Shweta, closing comments then. If one has to look at, let's say, a prospective return, and if one has to cut across all sectors, private banks, PSU banks, small banks, old PSU banks and NBFCs, where do you think there is a highest probability of a 15% return in next 12 months?
Next 2 quarters definitely augurs well for NBFCs despite the expensive valuations, because as we started our conversation mentioning that the overall macros definitely augurs well, especially the low interest rate regime for upper layer NBFCs. But private banks also are in the fray, and definitely the scenario looks stronger. PSU banks looks good from say we are in a very positive real estate and home loan cycle, so they definitely grab the market share. But yes, we have to be selective because in the entire BFSI space, as far as the valuation or the risk reward dynamics are concerned, then I think we would like to stay selective across these segments.
Dhyanada, Shweta, both of you, thank you so much for your time and getting this insight on how to read into the Q1 updates from banks and NBFC so far and what to expect as well going forward. But let's tell you what else